How has India finally earned the global validation for credit ratings? What are credit ratings and why do they matter so much for our country? And what is the global impact and future roadmap for us? After almost 2 decades, India has got the financial promotion. Standard & Poor's Global International Credit Rating Agency, that is S&P, has finally upgraded India from BBB- category to BBB category. Hello everyone, welcome to Vajiram and Ravi's Flash News. My name is Shubhangi Singh and today we are going to understand the significance of this particular change in credit rating. We'll also understand that how credit rating works and why it matters so much for our country, and then we'll be looking into the way ahead from here. So when we talk about this particular news, we have to understand S&P, that is Standard & Poor's Global, that is an international acclaimed credit rating agency just like Moody's or Fitch. So when we talk about such credit rating agencies, their credit rating becomes of a significant importance, and herein S&P Global has announced that India has moved from BBB category, BBB- category to BBB category, and this has happened almost after 18 years. And this is a clear endorsement to the global order that how India is showing economic strength in such globally chaotic times, and also it is an upgrade which clearly shows that how India is working towards economic resilience, strong economic infrastructure growth, as well as fiscal consolidation. So where government has been lobbying for such a long while, where such international credit rating agencies were understating India's economic growth, this is a sort of win, a financial promotion for India, where the government's economic as well as fiscal policies have been validated, and it will work in our favor because it will boost investors' confidence and also directly help us in strengthening India's global image. Now, when we talk about this particular rating, it becomes important for us to understand that what is credit rating and how it works. Before we get into that, let us look into more dimensions about this particular move that has happened. As soon as this rating change, this upgrade was announced, we saw a direct immediate impact in our economy itself, where bond yield fell in secondary markets. So how do we understand that? Simple understanding we have to take here. Bonds were being sold off. Sell-off was happening in the secondary market. Why sell-off was happening? Because of the tariff war that is going, the chaotic situation in the global order. There was a lot of sell-off in terms of bonds, and that is why the yields were increasing, because they need more to create demand. So in this very situation, as soon as this upgrade came, in recent times we saw the bond yields falling in the secondary market. Another thing that we noticed, rupee gained strength in international market, international forex market, and this is a economically important moment of time that we all need to understand. When we are talking about credit rating, let us start with understanding credit rating first. So when we are talking about credit rating, it basically means how capable a country is in terms of repaying its debt. मतलब कि country जो है, जो अपना उधार ले रही है, उसको वापस देने में कितना capable है, उसी को measure करती है किसी भी country की credit rating. अब इसी credit rating के basis पर, now the credit rating is the fundamental basis when we are talking about the amount or the kind of borrowing that government or corporations can do. So better the credit rating, lower cost borrowing is available, just like it is for you. So better your credit score, you will get better rate of interest, lesser rate of interest. So similarly, it is working at the global scale. The better credit ratings of the government, that means they have lower borrowing cost. Furthermore, it will also open up avenues for India in terms of access to new global capital pools which have not been used or which are untapped as of now. And it remains significant because of the fact, because for past 18 years, if we look at the record, we will find that there has been no change in India's rating, and India had been lobbying for the same when we talk about especially the international credit rating agency, be it Moody's, be it S&P, so that we are able to take advantage of the enhanced credit rating. So when we are talking about credit rating, now that we have understood credit rating, now let us move and see that how basically credit ratings work. So credit ratings are basically classified into two parts. The first part that you will see, it is the non-investment grade. So when we are talking about the non-investment grades, that means the country's economic parameters are such that the investment that will take place, that might not be able to give dividends. That means country lacks in the capabilities to repay its debt. The second category is the investment grade. So when we are talking about investment grade, it also has further classification where we have a high grade, we have an upper medium grade and lower medium grade. So as of now, if we look at India, it was at BB minus for S&P and it has been upgraded to BBB. And if we talk about the other ones, that is Fitch and Moody's, we are still in the same category for the other credit rating agencies internationally. So if we talk about the current scenario after the upgrade, India has the rating of BBB. That means it has adequate capacity to repay the debt, but it might be vulnerable if the conditions are not favorable of the economic scenario in the particular country. When we are talking about this particular category, we have many countries in the same category such as Greece, Mexico, Indonesia, and India aims to move from BBB minus to BBB that we are in now, and now we are aiming for BBB plus. So this is where our next target is in the category of countries such as Bulgaria and Italy. Then we have to understand also the fact that the top tier is entirely different, where we see high grade investment or prime investment happening. When we are talking about prime investment, there are certain countries like Australia, Canada, Germany, Denmark, who are already present in the top tier itself. Now let us move ahead and understand if an upgrade is possible, so is downgrade. So if we are talking about moving up the categories, if the conditions are not favorable, parameters are not favorable, then we see downgrade as well. And we have seen in past that notable countries, even for US, it was downgraded. It has seen downgradation in 2011 and 2005 by Moody's itself. Another thing that I would like to point out, that in the start itself that I mentioned the fact that Indian government has been lobbying for this upgradation for a long while. There is some sort of differential treatment that we have seen, and these international credit agencies have understated our economic growth, which is mentioned in our economic survey of 2021 as well. So if you look at this particular data, this is from back 2016, but even if you go into this, you will find that if we look at China, the credit rating has improved, but the GDP, the growth has seen a downfall, whereas our credit rating has remained constant, but our GDP has shown an upward movement. Even after that, our credit ratings were not changed for a long while. This upgrade comes as a good news, but there is still a long way to go, and this also shows that there is a clear effect of global order and international lobbying when we are talking about credit ratings as well. Now let us understand that what did India do to get this upgrade that we are talking about. What went right for India? When we are talking about this upgrade, there are three important factors that worked in our favor. The first one is definitely the fiscal consolidation. Second is the stable inflation, and third is the economic growth. So when we are talking about fiscal consolidation, let us look at the numbers. Our fiscal deficit from 9.2 just after COVID 2020 to 21, that went to 4.4. Now this reduction in fiscal deficit and responsible fiscal consolidation that we did not see even after FRBM Act 2003, and this final result is definitely an important pointer which was considered. Second thing that we see, the debt to GDP ratio is 57.1 projected for this year, and it is expected to reduce to 49 to 50% in next 5 years. Another important factor, as I mentioned, has been the stable inflation. If you look at inflation in recent times, RBI as the central agency, the inflation control by it has been directly praised. July 2025, you will find 1.55% has been the headline inflation. Now my question to you here, what is the difference between headline inflation and core inflation? And this headline inflation has been lowest since 2017, and this is a clear indicator that our economy is stable, and this gives an opening to the global investors. The third factor that is in front of us is the economic growth. GDP growth has been seen 6.5% in 2024-25, which is still the fastest, one of the fastest when we see around the globe, and our nominal GDP has been higher than the debt growth that we have seen. That means the debt burden that lies on us is comparatively manageable, and all these three factors combined have led to the upgrade that we are seeing from S&P Global. Now let us talk about that what lies in front of us. Because of this particular change, we have seen a direct impact that we will be able to attract foreign investors, and we will be able to strengthen the currency stability, in which form we have directly seen the impact where rupee has gained strength in the international market. But what lies in terms of the way ahead? So there have been clear conditions for the next upgrade by S&P in the form of guidance, that is, the center and state fiscal deficit needs to go below 6% of the GDP based on the structural basis. And when we talk about the implications from here, that if we get further rating boost, that means our credit rating goes to BBB plus, then we will get further lower borrowing cost. There will be encouragement to foreign direct investment as well as FPI, that is foreign portfolio investment. It will further enhance India's image and give us the stamp of stable investment destination. But the problem lies in the fact that when we are a developing country where a lot of welfare programs are running, it becomes a very difficult position to balance welfare as well as growth spending. So that is why it would be difficult for India to manage the next boost that we are expecting in rating. But nevertheless, we will be working forward to it, and in the bigger picture, India has arrived in the situation of tariff war, direct confrontation with US and Pakistan. This comes as a good news for our economy. What are your thoughts on this? Let me in the comment section. That was all from my side. Thank you so much.